going by the earnings that we've seen and the macro conditions, you're still pretty keen when it comes to US equities. When you talk about this rebalancing as we try and make sense of the inflation picture, what does that look like for a portfolio to you?
Well, third quarter earnings came in very strong, and it's really been all about the earnings. And when we look at some of the company reports, some of them do report that some of the supply side constraints are easing a little bit there. So I think that, on the U.S. market for the S&P 500, we're still on track for further gains here. And you still have that market activity, that cash balances are very favorable, and we think that the consumer demand is going to hold in here. But the equity and the bond markets are telling you different things. The equity market is much more bullish compared to the bond market, where there are really more concerns focused on inflation, lower growth possibilities. And I think, look, the inflationary pressures have been the largest gain we've seen on a monthly basis over the last decade. And we see the inflationary pressures broadening. Now, earnings are looking through that, but I still think you're going to see this disconnect between the equity markets and the bond markets.
What does it mean for the inflationary picture when, of course, we had retail sales just rising the most since March last month, despite the fact that prices continue to rise, despite the fact that consumer confidence seems to be sagging, but people are willing to spend, and not to mention that energy prices continue to be high?
Well, what we've seen is that the pandemic has really changed the composition of consumer spending. The U.S. consumer spending on goods is over $700 billion above the pre-pandemic trend. But if you look at the spending on services, it's still $300 billion below the pre-pandemic trend. But the other inflationary pressures are coming through. Energy prices. We do think that you're going to see energy prices more biased to the upside, staying at $80. A possibility of $100 is not out of the question. And then you have wage inflation, and on rent inflation, shelter inflation, we're looking at the highest housing prices globally in 40 years. So we've actually taken core CPI up by about 1% just off of the rent inflation numbers that have been coming out of housing price, home price growth. So I don't think you're going to see the concerns on inflation diminish, even if some of these supply side constraints are addressed. And I think the markets will begin focusing more on when the Fed will need to do something. And we've seen that in emerging markets, most central banks right now, particularly outside of Asia, they're all in hiking mode.
And to add to that inflationary concern, of course, we mentioned energy continuing to rise. And you're overweight this sector. So you're thinking that perhaps those prices will continue to accelerate.
I think so. I mean, I think OPEC Plus has actually signaled that they're very comfortable with oil at $80, not over $100, but I think oil is going to stay in this range. And when we've actually taken a look at some of the structural problems, we see that there's been chronic underinvestment by large oil companies in CapEx. We estimate that looking to 2030 for probably about a $600 billion shortfall. So I think you still have the upward pressure on energy prices here. Investors are still underweight energy, and it does seem to me that these pressures are just not going to go away anytime soon. So we're very comfortable with the energy sector, and I think that we see that still it's not as saturated as some other parts of the market when we look at positioning.
Joyce, we also spoke with Oaktree's Howard Marks, and he said, look, when it comes to China, whatever premium you're paying, you kind of better make it worthwhile, essentially. But his view is that we haven't seen a complete collapse in any sector by the government before. So chances are we're not going to see this here with the property sector. Do you share that view? And does the kind of risk premium start to look a little bit more reasonable in some pockets of that market?
Well, we are seeing some signs of credit easing here, and that the government was beginning to get worried that this is starting to impact the investment grade companies. So we have just seen that they are actually allowing more easing on mortgage approvals, also on the developer loans, some of the M&A debt assumption as well. And so I do think that this is something where it's looking really interesting right now. We see a default rate for China high yield property that's around 20%, but you look at where spreads are at right now, and it's pricing in a 50% default rate. Now that's highly unlikely to play out. So we actually do think that this is a moment where looking at China high yield property, higher quality names, some of the lower dollar price, it actually is looking attractive on the bond side.